Now we're going to talk about financial measures and costs of quality. So this goes back to chapter 11, where we talk about relevant cost information for decision making. So our future costs and revenues that differ between those decision alternatives. What are our avoidable costs versus sunk costs, the out-of-pocket costs, opportunity costs, and then that brings us to our cost of quality reporting. So many of our cost of quality help us to avoid avoidable costs. So future costs that can be avoided by choosing one decision over another. So when we look at if we decide to spend money on cost of quality or prevention, then we're going to avoid failure costs from having scrap work or other things. So we have our four measures of quality, our cost categories. Prevention costs. So these are costs that we incur trying to keep defects from even happening. Uh, Maintenance to machines, employee training happen under prevention costs. Appraisal costs are incurred when we're looking at inspections, when we're looking at data to find out if our products and services conform to expectations. Internal failure costs are failures that happen internally while we still have the product in stock. External failure costs are costs incurred after the customer has already received it, and now we're trying to rectify any defects in products or services. So some examples of prevention costs are quality training costs, equipment maintenance, employee training, appraisal costs, or any testing and inspection costs, vendor certification, so certifying our suppliers and our vendors to make sure that they're giving us the best quality materials, testing our equipment and instruments, quality audits to make sure that we're performing our best, internal failure costs, rework, scrap, any lost contribution margin because of schedule disruptions, because machines are breaking down, or we had to rework anything. External failure, these are usually the most expensive because this is after our customer gets it and a product or service fails. So we have customer complaints and returns, any lost sales or lost market share because of disgruntled customers, any repair costs. We also have the potential of lawsuits from dissatisfaction. On this slide, we have an example of a cost of quality report where we have our prevention costs, appraisal costs, internal failure costs, and external failure costs broken into categories. And we look at what the total quality costs are. We also compare our quality costs to the total sales as a percentage of sales. So we show our percentage of sales. What we would hope to see is in this, here we have a growth from year 0 to year 2. We've shown that we've spent more money on prevention and appraisal. And in doing that, we have been able to reduce both our internal and external failure costs. So that is what we would hope would be the result. If we spend more money on prevention and appraisal, that we would be able to eliminate or avoid future failure costs from quality issues. We can also break those down into conformance and non-conformance quality costs. So conformance costs are prevention costs and appraisal costs, and non-conformance costs are internal failure costs and external failure costs. So those are called costs of conformance because they ensure that products and services meet customer expectations so that we're conforming to customer expectations. Non-conformance means that we didn't conform to those expectations expectations and we didn't meet them. So those are those internal and external failure costs. We also have non-financial measures of quality. So what is our process yield, our productivity yield, any machine time setup? What is our safety record, our throughput record, our manufacturing cycle efficiency? So that was something that we covered in chapter 14. So there's a variety of non-financial metrics that we can look at to look at efficiency. When we're looking at these measures, we don't want to just focus on how efficient are we and does efficiency just drive quality. So we would want to look at other things. In actual practice, when we're looking at these measures, we would want to have some kind of a benchmark, either internal or external, that we would measure these quality metrics against. So some kind of minimum performance measure that we would be able to audit against. Non-financial quality metrics, external, would be when we're looking at what is our customer response time. That's also something that we looked at in chapter 14. The number of defective units that actually shipped out and then came back to us. How many customer complaints did we have? Did we have delivery delays? Are we on time? How long does it take before we have failure in products, and what is excessive failure? So those products that have massive failure and even could produce different lawsuits. Think about the Samsung 7 when that came out and the battery caught on fire on an airplane. That's an excessive product failure. We're going to review the manufacturing cycle time and the customer response time from chapter 14. So the manufacturing cycle efficiency is our processing time divided by the total manufacturing time. And then we look at that processing time. This is the value added time divided by the total manufacturing time, which includes value added and non-value added time. We want that measure to be affected by the fact that we're trying to remove non-value added things from our manufacturing process. Then our customer response time, or the CRT time that we talked about in chapter 14, is the time it takes from the customer, after the customer places an order for a product, for the customer to actually receive that product, and what is that time period. Another customer measure we have is called the Net Promoter Score, or the NPS. What this is what is the likelihood of a customer to recommend our business products or services? So what is the difference between the percentage of customers that are promoting our business because they're highly satisfied and those who are not recommending our business or are neutral about our business? Those in the middle are deemed passively satisfied. We don't look at those for the Net Promoter Score. So we're looking at this as an alternative to other measures of customer loyalty, such as our customer retention rate, and that are how many customers come back and buy a second product. So it is a measure of customer loyalty, but it goes beyond customer loyalty in how much are they bringing us in other business because they're promoting our products to other people. When we look at the non-financial performance indicators, what is their role within our performance evaluation? Well, one, they're readily available. They don't cost us a lot of money to generate the data. It does cost us money to analyze that data and break it down for. It's also important information to look at us, help us see what type of things need attention. So if customers are always coming back about the same exact thing, that is a precise area that needs attention. They can give us a lot of information or predictors of future financial performance. If we don't correct issues in our quality, that can affect our future financial performance and sales. How do we detect poor quality? Well, statistical information. We look for information, we use control charts, we have inspections, we gather information, and we take corrective action. So when we look at these statistical control charts, these are used to evaluate our processes. So what are the probabilities of having issues within a product line? What are the probabilities of having different quality failures or having different measurements? When we go back to that example of the steel that needed to be a 0.5 thickness, what's the probability of being outside of that parameter? So we set process control limits, and then we look at our inspections to see how well we're meeting those control limits and decide if we need to revise them. When we're looking at limits, what are those limits and how do we set them? So one is customer tolerance. What is the range of acceptable values? So what is that customer specified list? Then we have our internal control limits. So what is based on our behavior or our activity? The limits of our upper and lower based on just how we perform. So we just have an example of a graph here where we have a size 0.125 inches is our base limit, and then we have this range, our upper limit and our lower limit, and how many of our units happen within those upper and lower limits at each workstation. So when we look at the outliers or these observations for out of control processes, then we want to investigate those particular units. So why did we have 3 units that were outside of that statistical control? We can create histograms to show what factors we have. In this example, we're looking at things that cause chocolate mousse to fail. So in these different examples, we have different qualities that contribute to chocolate mousse failing. So the quality of the chocolate that we use, the liquor we use, the eggs we use, the blending speed and duration, and our refrigeration, and how each one of those different qualities contributes to the failure. So we can see here that eggs have a higher failure rate in quality issues for making chocolate mousse than the other factors. We can also create a Pareto diagram. So this is a ranking of the contributing factors to quality issues. So where improper refrigeration is the least, has the least cause-effect relationship, but the size of eggs has the highest contributor. This next example is a basic cause and effect diagram, also known as a fishbone diagram or an Ishikawa diagram. So what is the cause and what is the specified quality or problem of the effect? So the contributors to the cause. So when we look at this chocolate mousse problem again, we see materials, machines, methods, and manpowers. where with the irregular egg size, the wrong liquor, and the low quality chocolate have a higher rejection rate, and manpower and not following instructions and inexperienced workers versus just improper calibration of machines or improper refrigeration. The last thing that we talk about in chapter 17 is lean manufacturing and lean accounting. So in lean manufacturing, this is reconfiguring the entire manufacturing process to increase product flow and quality while reducing any non-value added activities. So we reduce inventories, we help improve decision making, we enhance profitability. One of the types of lean manufacturing, we have total quality management, just-in-time manufacturing. So we have 5 basic principles of lean manufacturing that we're going to look at over the last couple of slides. So accounting for lean, the value stream of lean, its pull and flow, and our empowerment and perfection. So when we're accounting for lean, we use value streams to measure the financial benefits of a firm's progress in implementing lean manufacturing. We look at what is the firm's products and services, we place them in value streams, and we look at those value streams compared to the cost and motivation. So what is the value stream? It's intended to support and recognize the value of lean operations and generates us more information about our underlying operating income. So we'll see an example of that value stream income statement. So we have an example where we have 2 different types of products, and we've separated each one of those products into its own value stream and looked at them individually and how they contribute to the overall operating income of the organization. So we see that the value stream of digital cameras is greater than the value stream of video cameras. This might look very similar to when we were looking at division analysis and we were looking at costs that were traced to the particular division versus non-traceable costs such as overhead and stuff, or this is where we're looking at 2 different products and what that value stream is. So we're separating out costs that are part of that value stream or contributed to that value stream and costs that are not traceable, or those overhead costs that are not part of that particular value stream. That is the end of chapter 17.